Hello and welcome to this edition of Adulting 101, brought to you by the Tahoe Regional Young Professionals. My name is Devin Middlebrook. I'm Executive Director of TRYP. So thank you all for joining us tonight in person and via the live stream, either from your comfy home or the Tahoe Mountain Lab down in South Shore. I want to thank Tahoe Production House for providing the technology in the live stream, and also Mountain Lab for letting us hang out down in South Shore at their place for the event. We're going to get started. The topic tonight is economic empowerment. Everyone knows about money, but we don't seem to often talk about it, and there's a lot of confusion around not only what you do personally, but also in business when you're starting businesses, what you need to know about money, retirement, bookkeeping. So without further ado, I'll introduce our panelists. Anique Dean is our first panelist, and as a teen, she grew up with a very strong work ethic she got from her grandfather. And after having spent almost 20 years in the hospitality industry, she switched careers and found her true passion, bookkeeping. She has been a bookkeeper and payroll specialist since 2005, and having landed her first bookkeeping position at Tahoe Keys Resort. Since 2010, she has been building a thriving bookkeeping practice with focus on small business. She is also a certified QuickBooks Pro Advisor and can offer significant discounts on all your QuickBooks products and subscriptions. If you're looking for QuickBooks, you know who to contact. Our second panelist is Max Baldwin. He, upon moving to the town of Truckee in 2013, Max joined Northwestern Mutual as an advisor with Northwestern Mutual. He works with clients to develop and provide comprehensive financial analysis, and then he assists his clients in understanding and identifying their needs and goals to reach their retirement goals. However, when he's not busy working with his clients, he can be found spending quality time with his wife, 2 dogs, and he enjoys skiing, paddleboarding, golf, and many outdoor activities. And moving to Truckee has allowed him to make a positive impact on the community, as well as enjoy the outdoors. So without further ado, we're going to turn it to Anique.
Hi. So I'm here to talk to you about budgets tonight. And when Brandy asked me to talk about budgets, I'm thinking 10 minutes is either way too much time or just nothing to begin, not even enough room to begin. And it made me realize that usually the problem with building a budget doesn't happen when you're sitting down to do your budget. It's what you did or didn't do before that moment. Too often I see people move to Tahoe and say, oh, let's start a business up here. It will be so much fun. And well, they don't necessarily do the planning. They're too excited. So really, before you even think about building a budget, you have to understand what you're getting yourself into financially, in your industry, locally, what all of the ingredients of what your business is going to mean. So as boring as it may seem, you have to do all of the research that you need to do for your business plan. Understanding your industry, understanding how your industry functions locally. All that information can be found online, and you can read about it forever and ever. The reality of it is, that only gets you so far in understanding what you're going to be doing. The real valuable source of information that you need to talk to before you even sit down to do your budget is someone else who's doing exactly what you want to do, or as close to it as possible. In your community, in the same area that you want to start a business, go find a few people who you consider are successful in that same area. Your definition of success can be different than mine. My definition of success means that these are people who are actually going to have the kind of success that they will be not only willing to talk to me, they'll be happy to. Because they will understand that, especially in this community, whether South Shore, North Shore, every single business that succeeds increases the chances of my business's continued success. And so I'm rooting for your business to succeed, and if I can help you, I'm going to help you. Go talk to your competition. The people who are going to be willing to talk to you, those are the people you want to talk to. Ask them all of the questions that bother you, all of the things that you researched online. Ask them what they think about it. And then ask them if there's anything you should know that you can't even imagine that you know. And listen to what they're telling you, especially if you don't like what they're telling you. A few years ago, I was helping someone put together a budget for their first year as a vacation rental. And my last job was at Tahoe Keys Resort, the big vacation rental on South Shore. And in his budget, he had determined that he was going to have 30% occupancy the first year. Now, 30% occupancy is a goal that 7 years ago, vacation rentals could still expect to achieve. I think now they're down to 20%. So a first-year vacation rental could expect about 10% occupancy the first year to be realistic. And when I told him that, he told me that was not possible. So I'm not telling you believe that it's not possible. I'm saying when someone tells you something you don't like, find out why that's what they think it's like. And find out what you can do to be different. Because I've also seen one small vacation rental company start with a very exclusive niche. And within 2 years, they had a 30% average occupancy. And they still maintain it today when the industry average is 20%. They figured out why it wasn't possible, and they did something different. So they learned from the, no, that can't be done. But they didn't do it by going, you must be wrong and I must know better. They did it by finding out why it couldn't be done and changing the game so that they could make it happen. So learn, learn, learn. As many people as you can get to talk to you, buy them lunch, buy them dinner, buy them drinks, and thank them for even especially the stuff that you don't like. And when you think that you have learned all of the things you didn't want to hear about your business, then you're ready to sit down and build a realistic budget. Thank you.
So now we'll go to Max, and then I've got some follow-up questions from you, and then anyone in the audience, feel free to pass the question up to me when we're done with that. And if you're watching at the Mountain Lab on the live stream, pass your question you might have to Amber, and using technology, she'll text it to me. So hopefully, if you have a burning question, we can get that answered.
All right. Well, as you know, I'm Max. I work with Northwestern Mutual locally here in the Tahoe, Reno area. And we help our clients understand a lot of different areas of financial planning as a whole. So tonight we're going to kind of focus on some areas of retirement planning, some ideas around that, some of the risks that are not always seen with that, and really just a little bit of education on some different options there. You know, really when we think about retirement planning, especially for us young individuals, you think, oh, it's way down the road, I'll get to it later, I have so much debt to pay off right now, there's too many things, I want to have fun, all my friends are doing this, what have you. Everybody's situation is different. So oftentimes, you know, it's just a matter of sitting down and just dedicating a few things. You know, there's some must-dos that really can help in the long run. And really one is to begin understanding the numbers. Oftentimes people, you know, it used to be this thing, hey, what's your number? What's your number? What age do you want to retire? When do you want to retire? Yes, that is great, and is a great place to start, but oftentimes things are changing over time. You know, shooting for one specific number today might be a different number 10 years from now. Inflation, taxes, whatever may change. But at the end of the day, setting a goal is a great place to start. And as life changes, we change the goal along the way. Another area is save early and save often. This piece oftentimes goes way overlooked because, again, like I mentioned, we have debt to pay, we want to go on a vacation, we want to do this. Well, it's all about allocating your budget in the appropriate way to kind of carve out some funds that are for the future, are for the rainy day. And then, you know, finding ways to invest in the right way and understanding also diversification. You know, The old adage, not having all your eggs in one basket, is an important piece because oftentimes in the long term, maybe that one area might not be the most successful, but having it spread across a number of different avenues, different strategies, that can prove extremely beneficial in the long-term strategy. One area that, again, is often overlooked is planning for the unexpected. You know, that long-term illness, business partner goes down, something happens to you, you're not able to work, you lose your job, the business goes under, whatever it may be. You have car repairs, whatever it is, now all of a sudden that savings is depleted. You know, not having the proper rainy day fund, not having the proper insurance coverage, those types of things can often really derail that plan. Without taking a look at the entire plan, you know, both defensively and offensively, you're not fully protecting yourself for, you know, that unexpected thing. And then oftentimes, you know, people don't really think about the pitfalls with retirement planning. You know, I mentioned diversification, but there is the possibility of being over-diversified, spread too thin across the different avenues and different strategies. You know, especially for us young folks, depending on Social Security, which in 30, 40 years, who knows what that picture will look like. Too much tax deferral. So deferring too much of the taxes till later, so you're going to be paying a lot of taxes in retirement. Anticipating lower costs in retirement, which, you know, if you read any sort of economic magazine or any sort of prediction, the costs are going to go up. Inflation is real and it's going to continue to go up. So knowing that today's dollar is not going to be the same in the future is an important piece to understand. And then also planning to work in retirement. Yes, some people say, oh, I'm never going to stop working. I'm never going to want to hang it up. Well, wouldn't you rather have the option to not work versus having to work? I think that's a good thing to do. So along the lines of the budget and allocating different areas, one kind of rule of thumb that we like to practice with our clients and help people to understand, again, every situation is different and we try to work towards this, but it's a 20-60-20 rule, meaning 20% of your income should be spent on saving and investing. So whether it's different IRAs, different retirement, 401ks, whatever your benefits might be, but beginning to allocate that into a short-term rainy day fund and then also a long-term, you know, retirement specific fund, and just that adage of paying yourself first, knowing that, you know, you need to put something away for that short-term, that mid-term, that long-term goal, and that creates a discipline around that. And then 60% of your income should be spent on the essential expenses. You know, your housing, your food, your transportation, children, healthcare, insurance, paying down debt, focusing on those things that aren't going to go away. They're a constant, and you need to make sure those are taken care of because that's your livelihood, that's what's important. And then the other 20%, you know, that's your discretionary expenses. So the fun stuff, you know, entertainment, personal, and then also if there's some extra money left over, hammer down on that debt a little bit harder. That way, you know, some extra money, that extra $50 towards principal versus paying on that interest is going to shorten that length of that loan that much more. And it's going to feel that much better when you wake up in 10 years and that loan's paid off versus that 15 years. And one important piece that oftentimes we coach our clients on is the true cost of waiting. You know, we've run some analysis out that the longer you wait to accumulate money and start saving specifically for retirement, you know, in this model, based off of, you know, assuming a 7% growth rate or rate of return, if you were to start saving $381 a month at 25 years old, you would be able to accumulate $1 million by age 65. That same amount for a 35-year-old is $820. That same amount for a 45-year-old is $1,920. And if you were to wait till 55, you would have to save $5,778 a month to accumulate $1 million by age 65. So that just kind of shows you, obviously, you know, not everybody's goal is to be a millionaire, but there's, you know, if you think about $381 a month, yes, it does sound like a large sum to some people, but, you know, think about how much Starbucks you drink or how many things you could carve out of your budget to allocate in a different fashion, you know. You could pay $7 a month for Hulu versus $17 a month for Showtime. little things in there. And then also you want to think about the different choices you want to have for saving for retirement, as well as the choices you want to have in retirement. You know, when we talk about taxes, that's a big piece of it all, because do you want to pay taxes today or down the road? Or which tax bracket are you in today versus down the road? So those have a lot of different impacts on the saving strategies today and the choices you want to be making. You know, when we talk about taxable accounts, we're talking about, you know, ordinary investments, brokerage accounts, savings accounts. Those essentially are monies that are taxed daily and regularly. We talk about tax deferred. Oftentimes, companies offer 401ks, 403bs, or if you're self-employed, a traditional IRA or simple IRAs, SEP IRAs, those are allowing you to defer taxes till later. So those contributions are made pre-tax and are essentially deducted from your income today, allowing you to save on taxes today and then pay that tax down the road. Another area is a tax-free area, meaning a Roth IRA, and there's you know, limited options in that realm because of income limitations that the IRS puts on there, but that allows you to pay taxes today so that down the road you can have tax-free withdrawals, which can really have a great impact depending on where your tax structure is in retirement. Another area that we look at is annuities, and then also life insurance can be a beneficial piece of retirement down the road. But oftentimes people, again, overlook the risks involved with the retirement. You know, one piece that people don't really think about is longevity. You know, will you outlive your money? How much have you actually saved, and how long did you plan to have that money? Will it last? That's one thing that oftentimes people don't understand. And then market volatility. You know, since 1945, the S&P has averaged a correction of at least 10% once every 18 months. So that means there's going to be some volatility. So again, going back to having all your eggs in one basket, if everything's invested in the market in retirement, then you know what happens when the market's down. Now your money is not worth nearly as much as it was before. Inflation and taxes. You know, an average inflation rate of 4% can cut your purchasing power in half in just 18 years, meaning that same dollar today is now worth 50 cents in 18 years. Quite an impact on what that retirement picture can look like. Another piece is healthcare. With the rising costs over the last 20 years, healthcare costs have risen between 6 and 8%. So think what that's going to look like again, flash forward 20, 30 years with those same costs. That needs to be equated into the plan. Long-term care, you know, 70% of people over 65 will experience some form of long-term care needs, which again ties in with that healthcare cost. Not all of that is covered under healthcare. You might need specific care, acute care, in-home care, and again that can be very costly and that can eat away at your retirement assets. And then the legacy, making sure that there's something left over to transition to the next generation, to a charity if that's something that's important to you. You know, again, it's all dependent on what your situation is and what you're trying to accomplish in the long run, but really just taking the time to create a discipline around saving and identifying what the best strategy is for you, because things are going to change, both in the industry, both in the economy, both, you know, with whatever you're doing personally. You might have some hardships, it might be a few tough years, but planning ahead for that and knowing you have the ability to withstand that can pay dividends in the long run. And at the end of the day, just taking the time to carve a little bit out for the rainy day and down the road can really be beneficial. So, thanks.
Great. So, Nick, I'd like to ask you some more details about budgeting. Maybe if you know, you focused on businesses and business budgeting. Does that happen on both the revenue side, what you expect you could maybe make, and the expense side, the cost for running your business, and sort of maybe describe some of the common expenses or revenue streams that people often miss, forget about, overestimate, underestimate? What are sort of some of the common pitfalls people have when budgeting for a business?
Well, the first thing is income is usually overestimated. That's a given, because I think that most of us who have started their own business know that if we didn't expect things to be better than they turned out for at least the first year or two, we never would have had the courage to do it. So we have to be overly enthusiastic about it to even do it. So the first thing we do is overestimate the income, that every time. Things that people often don't think about, surprisingly enough, is like office supplies. Oh, I'm going to need a printer. Yeah, even in this day and age, sometimes you have to print things. Sometimes you want them on record. What kind of technology are you going to need to be able to keep records for your business? Every business is different. So office supplies are often overlooked. Things that are very industry specific is like advertising. For example, in an industry like bookkeeping and accounting, my advertising is mainly my subscriptions, like with QuickBooks and whatnot, and then word of mouth with my existing clients. So I have zero advertising costs, really, like what is traditionally considered advertising. My advertising is more of a marketing thing where this is advertising in a weird way, not anything that I can expense, but whereas if you sell a product, then your advertising costs are very easy to underestimate, especially those first couple of years when you're putting your name out there going, hey, look at me, I exist. You're probably going to want to spend a whole lot more in advertising than you're planning. It depends on your business. Most of the expenses can be so industry specific that it's really hard to even consider. For example, my husband's business, he has zero office supplies because I do all his administrative stuff, right? So now that's very industry specific. It's not just his business, but other circumstances. So it's really case by case, and that's why talking about budgeting is either how many days do you have, or because you can't cover everything. It's so industry specific and even individual specific. If you think about, an employee, a John Doe who goes to work every day and gets W-4 and his only worry about taxes is the W-4, even that budget, depending on this person's interests. I like this sport that costs a whole lot more money to get the equipment than that sport. Even every individual budget, how to plan your expenses is going to depend so much on the individual's interests and needs and whatnot. There's just no way to generalize it, really.
So I'll keep you up here. So you spoke, about business budgeting, but is budgeting for your personal life just as important as business budgeting if you're starting a business? Or maybe you can touch a little bit on budgeting for personal life, because I think that's one thing I know I don't really look at as closely as I should.
Well, as Max pointed out, to even begin to think about money, you need to start with a budget. And sometimes the best way to start with a budget is, QuickBooks. Just look back and record your expenses since the beginning of the year and pull reports and see, oh, okay, so I spend this much on groceries, I spend this much on, that pastime and meals and restaurants and whatnot, and create your history so that you can say, okay, this is how I spend when I'm not even thinking about planning for the future. So how can I make small changes? Because small changes are a whole lot easier to make than big ones. It's easier to stick to them in the long run. So look at what you already do and tweak that, make changes there. Cut your Starbucks in half. You go to Starbucks every morning, go every other morning. Boom, all of a sudden you got $20 extra every week, But start where you are, accept where you are. Yes, I blow $100 a week at Starbucks. Okay, I don't like it, but that's what I do. Okay, now how can I cut that in half? Boom. And yeah, it's create the history. That's the easy part. If it's for your personal, you can pull your bank statements. Don't use cash if you want to create a history. But pull your bank statements and you can recreate where you've spent your money the last year, 2 years, however long you want to go back. And then you've got your history to start planning for the future. This is what I do when I'm not thinking, how can I make the changes to be more conscious of my spending to plan for the future. But start where you are, just like anything else.
Thank you. So this, Max, this question's for you, and came from the folks listening to the live stream at the Mountain Lab down on the South Shore. So they asked about investing in precious metals. What percent maybe they should have of their portfolio? Or maybe just touch a little bit, because it always seems like gold, silver are somewhat stable. They grow. It's maybe a little, seems less risky than stocks, which are just sort of a piece of paper relying on some company doing
Right.
well.
So the commodities sector has, I don't know the exact figures off the top of my head, but they have performed well over time. But again, like anything else, there is risk involved, because at times they're going to lose value, quite a bit of value. So having a portion of that inside of your portfolio is never a bad option. But again, over allocating too much into one asset class can have detrimental effects in the event of that asset class suffering. And depending on where the economy goes, we can't predict the future. If we could, everybody would do what I do, we do. But all we can do is just kind of hedge our bets against, all risks. So hope that answers some of it.
Yeah, no, definitely. I'll keep you up again.
All right.
Another question that came in is sort of you, when you were talking, you mentioned Roth IRAs, 401ks, this, that. I know there's a lot of the options out there.
Mm-hmm.
Some employers offer one or the other, both. But say you don't have something that's offered by an employer yet, or you have your own business where obviously you're on your own. But what are sort of maybe the 2 or 3 top different types of accounts you should have some money in, and can you maybe give a little bit of detail about each one?
Yeah, so in terms of being an ordinary W-2 employee, where you're making, just normal paycheck, taxes are paid on a biweekly, weekly, monthly basis, however you're paid. If the employer does not offer any sort of retirement plan, if you're under the income threshold allowed for the IRS, depending on if you're a single filer, joint filer, Darren's world, you might want to be thinking about contributing to a Roth IRA, because you're paying your taxes today, so having a tax-free bucket to put money into, to pull money out of in retirement is a great option. Now, if you're a sole proprietor, you're working on your own, or you're a 1099 employee, not paying taxes today on those dollars, now something like a traditional IRA where you can defer those taxes for the future, you can deduct those contributions today, that can be a great option. A step above that, depending on your employee structure, again, if you're a sole proprietor or a business owner, if you have employees, offering something like a simple IRA, and contributing to that, again, if you're an employee, is a great option as well, because that's, again, deferring taxes. As an employer, you're deducting those contributions. I don't want to step too much on Darren's toes here. But again, another option is a SEP IRA, depending on your employee structure once again. And that's where working with an advisor, with your tax advisor or financial advisor, whatever, to really pinpoint what the best option is for you based off your income. Because there is income limitations for contributions to certain accounts. So if you begin to make too much money, the IRS doesn't allow you to put money into certain areas. You can only put a certain amount of money into, say, a traditional IRA or a Roth IRA. They do allow you to catch up a little bit when you're over 50. However, there's only so much you can do there. So having an expanded horizon to save in different options can really be beneficial. But again, you want to pinpoint that with education through an advisor, or if you have the time to do it on your own, can be the right way to go.
Thank you. So now I'd like to introduce our third panelist, who I'm going to assume got stuck in some of the road work around Tahoe. This is Darren M. McDonald. He's a certified public accountant. And Darren founded his public accounting firm in 2010 on the border of California and Nevada, initially serving clients in the Lake Tahoe area. But now he has clients from California to Puerto Rico, and the vast majority of the firm's clients are small businesses with up to $5 million in gross revenues, and the industries of investment partnerships, real estate, construction, specialty trades, restaurants, food service, professional services, and health and wellness practitioners. So Darren, thank you very much for joining us. And I'll let you take it away, a little bit about taxes, what you do, what some of our members should look out for, and then, just stand up while you respond.
Of course. So what I was asked to do was something more along the lines of small business taxes. And the best way to introduce that to people who've never seen small business taxes is to start with how the individuals are taxed. Most people just have jobs, so they'll get a W-2 at the end of the year. They'll look and they'll hand that to someone to go and prepare their tax return. That goes into a black box. Magically, a return comes out. And you either get a refund or you have to write a check. It's all very sad. What we usually, in a more comprehensive view, when you look at taxation as a whole, you collect a paycheck, and before you got to take the money, a bunch of people took money out for you. So the IRS takes out a good chunk, 0 to 20% usually. Then your Social Security tax comes out, that's another 6.2%. Then your Medicare tax comes out, 1.45%. And then if you're in California, for example, that comes out, that'll be somewhere between 4 and 8% of pay. And then they'll take out things for state disability insurance. That's about 1%, a little short. All of that comes out before you even touch your check. And then you'll go and you'll write, let's say you go and spend some of that money. If you go to a restaurant, you'll start by paying a sales tax on top of that. And then after that, maybe if you have a drink, you can pay one of the sin taxes that we have on alcohol and cigarettes that go on top of the sales tax. And then if you go to fill up the car, you go and you pay some fuel sales taxes that have been booked in to the price that you see, so that you don't necessarily are aware of all the taxes that you pay. When you do it in small business, no one did that for you. You just get the check. And then a bunch of people line up with their hands out and say, write one for us. And that's what usually hits everyone by surprise, is how many of those taxes, because now you're writing a check for all of them. And so a lot of people start to catch on how much small businesses have to pay when they're suddenly coming up with their own tax money. So that's what most of my practice is trying to minimize a lot of that taxation as much as we can. And we do that with a variety of structures. Sometimes you'll hear words like S corporations and LLCs. What we usually find is that there are some legal forms of entities that are usually formed for liability protection. We always tell people form a business entity if you're going to have employees or if you're going to rent space. Those are the first two things a small business usually want to do, that we say, okay, you want a business entity to do that. So, because employees are people you have control over, and they go out and they create liability for you. You don't even have to do it. And then, and then a lease is just a very good idea, so long as you don't personally guarantee the lease, because if it doesn't work, you need to bankrupt the entity so that you can get out of the lease. Sometimes that becomes a necessary evil. So try to protect things. And then while you're in those structures, we make a lot of tax elections. And all of that's really designed to try to get to your goal. Now, what I tell people in all my practice is there are no silver bullets. There's no one size fits all. This is what you need. What you need is a Puerto Rican corporation with an offshore in the Caymans or Barbados. That's what Uber does. And then you run into you just run your money through a credit card out of a Mexican bank. I am not making any of this up. These things were sold in structures and plans to people that said, oh, I just avoid all my taxes because I have all my money go to my Mexican bank account, and then I just use their debit card. And people would use them for about 5 or 10 years, and then they would discover that there's this huge tax problem that they've created for themselves. And this huge international fraud problem because they haven't been disclosing any of this. And and as an example, about 15 years ago, someone at the IRS, I don't know, they watched a movie or something, every now and then they do that, and a new tax policy comes out. So they came out with a policy that, okay, we'll let everyone just come in. And they hoped that they would raise somewhere in the vicinity of like $50 million, and the deal was pretty simple. No criminal charges, no problems. You have to pay the tax, we can talk about the interest, and you have to pay some, and we can talk about the penalties. And we'll work out plans for you. The first round of it raised about $100 million of just blanket amnesty that nobody knew existed. And then once they started selling it, it became the top revenue-raising function for the IRS. So people get really creative when it comes to taxes. And there's a lot of things people get sold. I tell people is, you have to start with a goal. What is it you want to do? Do you want your kids to go to college? Do you want your kids to go to a trade school? Do you want to have children one day? Are children even in the mix? Do you want to own your home? Do you plan to move a lot? Ultimately, you want to try to build a tax strategy that fits what your goals are actually going to be. And if those goals involve, I have clients who unfortunately lost a great deal of property in Puerto Rico very, very recently. But for them, it's sort of bittersweet because they've been phasing themselves out of Puerto Rico and they've been moving up here. So a lot of things were already lined up, and you can't really get like property insurance in places like Puerto Rico. So they're dealing with that loss. But there's a tax strategy for that, to try to capitalize on some of that so they can get some deferment. We call those casualty losses. The same thing happens in business. When we deal with businesses, we're looking for where are they going. Do you want to be, are you a solopreneur? Your job is to build a job for yourself for the next 20 years, and maybe you'll have a virtual assistant. Okay, then there's a tax strategy that will work for you. Is your goal to build a small office, 2 or 3 people? You're sort of the technician, and then you're looking for a couple of people, a model of like a doctor with several nurses and techs that can do various professional things, but they're really just to sort of move things forward. That's functionally what a dentist office usually is structured as, where you have the single professional or 2 professionals, and you're surrounded by hygienists and techs that sort of just capitalize the time that move things forward. So that's a model. And so to feed into the discussion about retirement plans, how are you going to attract and retain employees? What are the ideal approaches you want to do to, what are people going to expect? For me, in my firm, I have to offer health insurance. So there's a tax approach to that. Do you want to just do regular insurance? Do you want to do what we call a shop plan to try to get some health tax credits? Do you want to offer a daycare center in your home? It's because most of your employees are going to be working mothers, and so you want children to come in. What are the goals for your business? Or are you looking to build, a 3,000 employee business, and that's going to have something in the vicinity of 100 million in revenues? There's a path and there's an arc for that. And it's not going to be one size that fits you. It's going to be, okay, we're going to start in this model, and we're going to graduate up. And these are the tax structures we have to do. So a few terms that basically you'll hear all the time battered about. S-Corp is a tax election. It is not a legal entity. If you say you have an S-Corp, that means you made a tax election to tax whatever legal entity is you have as a partnership that doesn't have self-employment tax. So that's the number one reason people form it, is to avoid self-employment tax. What is that? Remember that Medicare and Social Security tax that you pay as an individual? It gets taken out before you even see your check. Your employer matches that. When you're self-employed, you pay both sides. So that part of your tax doubles on you. Works out to 15% of whatever the net of the business is. So one of the ways we manage that is with S-Corps. You have to, and instead of doing it on the net of the business, you do it on the payroll that you want to take for yourself. How much do you pay yourself? Well, you have to maintain a reasonable payroll under the IRS codes, but are we tying those in with an investment plan? Do we need to keep your salary up a certain level because you have a SEP IRA and you can only contribute 25% of what you pay of what you collect and pay into a SEP IRA? So maybe we need your salary to be higher because you're going to put $20,000 or $30,000 into that and defer that from taxes. So that's a lot of the terms of what we think of as structuring.
So I'll actually keep you up here. We've received a couple questions from our South Shore stream at the Mountain Lab. So this person asked that they said they're looking to buy an SUV for their business, and they're a sole proprietor. As a sole proprietor, is the taxable income off of what my company made or what I made as a whole that year?
So there's 2 lines. One is going to be what you pay the self-employment tax on, and that's going to be on what the company makes. What the company makes is basically what you would think of as your wage earnings if you were an employee. So that's the number that comes off of the Social Security tax. So that you're going to pay 15% as a sole proprietor, 15.3% on that number. Now, under that, we're going to have your other deductions, your itemized deductions, your personal exemptions, maybe some credits. Under that is what's going to be your taxable income. And that taxable income is where we're going to see federal income tax, if you're in California, state income tax. Those are going to be, so it'll be a different number. So you'll basically be paying tax on two different lines. Now, in terms of like using an SUV, this was one of those things that we had a tax policy, basically, where if you buy a car, a regular car, you can depreciate, or you can basically expense chunks of that vehicle off over time. And because people would do that with a vehicle that was a Toyota, and then other people would do it with a vehicle that was a Mercedes, rules came into play that are called the luxury car caps. You could only take so much in any individual year. We made an exception for those for vehicles over a certain weight. And so that's where the SUVs came in to play. If you bought the heavier vehicle, you weren't subject to the caps. So you could take a larger depreciation deduction each year, or under a provision called 179, you could take all of it in a single year. And basically for the last 15 years since the Bush administration, which was in the last major tax reform, we introduced bonus depreciation. We could take half of it in the first year. Those became very popular, and pretty soon, of course, someone in a position in the service was no doubt driving their vehicle, possibly also an SUV, down the road, and they could hear the car ads. Come in before April, and you can write off your entire vehicle against your taxes. This naturally caused policy to change. So there is a cap now for vehicles that are defined as an SUV, and that's $25,000.
So this person mentioned specifically 6,000 pounds or over, potentially.
Yeah. And that's the curb vehicle weight, is what we're looking at when we make that determination, which is provided by the manufacturer. So it's not, okay, I need to put more things on the truck to get it to fit. There's actually an additional tier, 15,000 pounds, which is your commercial heavy rigs. And these rules don't affect those. So we created a $25,000 rule. Basically, a vehicle that's not a pickup. So pickup has that has a minimum of a 6-foot bed, so 5-foot bed won't count. And a vehicle that's not a van, a vehicle with less than 14 inches or less from the dash to the front of the vehicle. Those are not considered SUVs. And then everything else is considered an SUV. And those are subject to a $25,000 cap. So you go to the car shop and you say, okay, I'll get a loan and I'll get a $25,000 deduction for my business if I use the vehicle in my business. And that's a big, important part. You have to use the vehicle as part of your business. And we use that based off mileage. So it's a real deduction. Yeah.
Great, thank you.
Yeah.
So this question is for you, Max, again from our stream down in South Shore. What rate is normal for a person to pay to have their retirement portfolio managed by a professional such as yourself?
So that, that does have some variables. If you are working with a profession, usually depends on assets under management. Most advisory firms, especially in, as of late with the Department of Labor's fiduciary ruling, you are charged an annual fee, and again, that depends on the assets under management. You can expect to pay anywhere from 1.5% to 1.65% on assets under 100,000, above 100,000 to 500,000, potentially, you know, in the 1.3 range. Could be lower, could be higher. Again, depends on the type of firm you're working with, the magnitude of their assets. Some of the larger clearinghouses out there and larger investment firms do offer a little bit different now with the robo-advisors, firms like Vanguard. Oftentimes you can get index funds, which are, you know, just track the major indexes out there, the S&P 500, NASDAQ, what have you. Those are less expensive, but there's less active management. You're not necessarily working with an advisor. Vanguard, coincidentally, actually put out a study stating the value of an advisor. It's actually a pretty cool read about just helping people emotionally invest differently, or take out the emotional part of investing, rather. So that's really where having that professional advisor to help you kind of walk yourself off the ledge when maybe the market's tanking a little bit, and to not pull out and not sell when it's down and buy when it's high, and all the things that don't project longevity. So that was a roundabout way of saying the fees do differ along the way.
Yeah. So actually, I'm going to open this question up to all three of our panelists, maybe starting with you, Anne. Could you maybe touch on some online resources for budgeting, taxes, retirement? They don't have to be necessarily free resources, but free resources are always good. But what sort of things are out there to help people budget? I know you mentioned you're a pro at QuickBooks. So just sort of some of that technology and resources that our members today can go and access to sort of dip their toes into the world of finances.
There's actually so much that it's hard to know where to begin. I mean, even Square now is offering solutions where you can keep track of expenses and do invoicing and whatnot. It's really, there's so many choices. It's really hard to know where to begin. To me, the scary part as an accounting professional is how good all these companies, including Intuit and QuickBooks, have become at convincing people that they can figure it out themselves. And, you know, I end up making a whole lot more out of cleaning up a bad setup than I would have setting it up to begin with. So, I mean, free, I would say if you're at the point where you're still looking for free, play with Excel. The equations can give you all of the financial documents. I mean, Excel was the first financial software. It represented the papers. They put the papers on the computer. So Excel will give you all of the, you can create a budget right off of Excel. When you start with small monthly fees, you have QuickBooks Online. There's Xero, there's Square, there's, I mean, there's really, there's no end to it. QuickBooks Online, what I love about Intuit as a company and this new product, QuickBooks Online, they've been working on it for 10 years, and 10 years ago, you couldn't pay me enough to work with that program. Today, I love it. It's a game changer. They've made some huge improvements. And companies like QuickBooks and Xero, where they're specialized accounting software companies, they understand the whole process from beginning to end, reconciliations, really getting your whole picture in a way where you're also getting accuracy, not wishful thinking. You're actually checking the numbers, because whatever program you use, it'll believe whatever you tell it. So you need to use the tools to verify the accuracy. When you get into some of the free stuff, you don't get that complete picture, or you don't get the reporting ability that is the whole point of doing the data entry. So when you're looking to free options, you want to look at what you're getting, because maybe you're completely wasting your time in the sense that you're not going to get the financial picture that is the whole point. QuickBooks Online has some really affordable solutions. I know Xero is bringing up their game. Xero spelled X-E-R-O. But QuickBooks Online is still, for 40 years, QuickBooks has stayed ahead of the market and provided tools that are above and beyond. From small sole proprietor making a couple $1,000s a month to large businesses with multiple employees. They have add-ons. It's a beginning to end where you can start small and build up on it, so you're not changing systems. That's the other thing. If you start with one free system, are you going to be able to take this information and transfer it into the next system that you're going to come up with as your business grows? Right? Because you're going to need another, your accounting system has to grow with your business to provide all your needs. So if you start with something free, is it going to be compatible with whatever the next thing is going to be for you? So that's, yeah, it's a jungle out there. Sorry.
Darren, I'll go to you next. You know, software, tools, resources.
So if you look for anything on taxes on the internet, you're going to see a wide range. You're going to see on one side what we might consider the very honest, and this is the way to do it. On the other side, you're going to see taxes are a fraud, and we should all just rebel, right? And everything in between. What I would tell you is the quality of the advice is probably the most important. If you're not sophisticated in this area and you want to learn, there's a number of very good quality blogs out there, and there's a lot of good quality Twitter feeds that carry some things. Forbes has a girl, I think her Twitter handle is @taxgirl, or she's the tax girl. And she does mostly entry-level sort of posts. And just sort of begin making yourself aware of that. Yahoo Answers tends to actually be pretty productive because there's a lot of people that do that. LinkedIn actually has a very robust article publishing board sites. Most of those are very valid and very right on. So those would be the first couple areas I'd look for in trying to sort of educate people in this general direction. As far as products to use, if you're just starting out, Tax Act is a really good product. They will do pretty much the entire return for you in any state under $50 with the e-filing. And I'm very happy with the comprehensiveness of their low end and their low-cost products versus, say, some of the other products I've seen, which they will do some of the return, but for more they need more money. And I have problems with that. And most of those boards, TurboTax, of course, made a very large name. It's an Intuit product. And Intuit has largely bought up a lot of the professional products over the years. So in an effort to sort of, I think they're trying to go after CCHs in terms of building that market. But as a result of that, they've built a lot of bulletin boards and blog posts there, usually staffed by licensed people who are doing it at a ridiculously low wage rate, but they're providing quality support. So those are some initial free resources that are good approaches or can point you in the right direction of where to go. So.
And then throwing it to you, Max, on resources around retirement. And then specifically, I guess, a personal question of mine, I maybe touch on these, but I use like a Wealthfront and Robinhood for some of my investments. So I know there's a lot of tools out there.
Yeah, and that kind of touches on what I mentioned before, the robo-advisor in the sense. And that, it really kind of, similar to what Darren was saying, it all depends on how much research and time you want to spend on these things doing yourself. Oftentimes people are intrigued with it. Maybe they have a few hours every day to read what's going on in the market and read what the latest thing is, to read the new tax laws for each year, what contribution limits may be. Those things are always changing, so you might not know or might not be relevant to your situation, that type of thing. So again, there are a lot of resources out there. To Darren's point, there are a lot of great resources, and then there are a lot of really biased resources, or not fraudulent, but not necessarily correct in a lot of ways, and maybe misleading. Maybe their blogs have certain people had bad experiences in some areas or were steered the wrong way. There's a reason we have the SEC involved in a lot of regulatory processes around advisors and the things we've done, because I don't know if people may have seen The Wolf of Wall Street, but things have changed drastically since. Things are regulated a little bit heavier these days. So again, working with an advisor is a great option, but again, just having education. So if you have the time to do it on your own, there's plenty of great resources out there. A lot of people use mint.com kind of in a budgeting manner. The Robinhood, early investing, there's lots of ways to kind of, save the change, if you will, and put it into a small type of fund, and just kind of ways to do it on your own and do it cheap. But again, the more complex it is, the more money you're making, the more you want to be sure you're doing it the right way. So hope that helps.
Definitely. So this question is, I guess, either for Darren or Max. So this person was advised to place $3,000 in a traditional IRA in April before filing their taxes, and they were advised that they would receive a $2,600 refund back on their taxes for the investment. Is this true? And if not, or if it is true, what would you advise?
So there may be 2 or 3 things going on beyond just that. So Normally, a contribution to retirement account is going to reduce your taxes by whatever your tax rate is. And usually, the way tax rates are structured is everyone starts at one rate, and then they make a little bit more until they qualify for the next rate. That doesn't move all of your taxes, all of the dollars up. Just the top dollar is being taxed at the new rate. So the rate starts at 10, and in the federal system, it starts at 10, it goes up to 39. In the case of like state taxes, the rate in California starts at 1, most people fall into the 9.3, it goes all the way up to 12 and 12.3. What I would expect is actually happening there is two different things. One is you're making a contribution for $3,000 into an individual retirement account. If your tax rate is 25%, and maybe you also have a state rate of 9%, maybe you're getting a third of what you put in reduced taxes there. So that would be like $1,000, right? It's also possible, but your tax rates wouldn't be this high if it was, that by doing so, there's a small credit called the Saver's Credit, in shorthand, Retirement Saving Credit. And pretty much once you make more than $30,000 a year, you don't get this credit. So, but it's basically a graduated credit for what you put in. It actually comes in pretty handy. I have a client, for example, she makes a Roth contribution because the Saver's Credit is high enough. Her income is really low, but she doesn't need to spend most of what she makes. So we get her to put some money into a Roth IRA, which normally would not create a tax deduction. But it's good for the credit, and the credit comes in and pays whatever remaining tax she has. It's unlikely that I could see a $2,900 or $2,600 one. That combined seems unlikely. It's very possible that by doing this, maybe you're also freeing up some other deductions. Because contributions to retirement accounts are what we call adjustments to your income, they can free up some other deductions that you might be phasing out of because your income is too high. And by making the retirement contributions, you're lowering your income and thus freeing up your ability to take certain things like medical expenses, like a dependent care credit that maybe you're making too much money on, but by reducing, you're suddenly going to get $600 for that dependent care child credit. So it's probably multiple things to get to $2,900. It would have to be quite a few to get to that high. But there is a legitimate deduction there.
I defer to Darren. Perfect. So Max, you had mentioned sort of when you're planning for retirement having that rainy day fund. What sort of rough percentage of your, I guess, monthly expenses or bills should you have tucked away, and how do you balance building your rainy day fund versus your retirement account?
So with that, ideally in a perfect world, 3 to 6 months of your fixed expenses. So that big 60% we talked about, having 3 to 6 months of those in a rainy day fund, like I said, in a perfect world, can really help you, withstand perhaps a layoff at the job or sickness, an illness, an injury, those types of things. Again, that's where it comes down to really budgeting and figuring out what's most important. Some people don't want to feel that security and just want to live in the moment every day, which, oftentimes in Tahoe we do. Need those new skis and that new mountain bike. But also with that, you just want to, adequately budget. Like, yes, these numbers are maybe the standard, if you will, but what is actually real for you? So taking, maybe if you just work towards, hey, I want to make sure I have 1 month. All right, now that wasn't that bad. Now I can make sure I have 2 months, and just slowly working towards that while still not changing, paying yourself first in the long run for the, investments or the retirement accounts, what have you. So again, it's just knowing and having a better grasp of what you're actually making versus what you're spending to see where those few extra dollars are, because, like you said, you can find $20 a week, turns into $80 a month. That can add up pretty quickly, if you just have that discipline. So,
And then, Darren, going back to you, we are situated on California-Nevada border. So maybe you could touch on a little bit of the benefits or disadvantages of where you maybe want to start your business, try to live, between the different taxes in California and Nevada.
Yes, I pick up, I joke that I pick up a lot of California refugees in my practice. People who are fleeing the state for tax or fee purposes, sometimes for insurance purposes. Most of the time, it's because something has changed in their world. They're selling the business, so they want to try to avoid giving 10% of what they're getting to the state. There's a number of advantages to being in California, and there's a number of advantages to not being in California. Certainly, there's obviously two different states and two different state laws, and lawyers are always going to tell you which one is going to be better than worse. And most people tend to lean in the direction for liability protection of Nevada. But Nevada also has a very high set of fees because they don't have a really thorough tax system. They have a gross receipts tax system that affects a small number of the businesses that are out there, but businesses with more than $5 million in gross receipts are going to pay some, what they call a commerce tax to Nevada. So there's a number of business taxes, employment taxes, but they're not significant. Most of Nevada's money is raised through fees and some through property taxes. So sometimes to avoid fees, it might be cheaper to operate in California. It really is business specific. Most people will say you're going to win in the income tax world by being in Nevada. My wife and I have kind of pushed the numbers around. She's an accountant too. We met at a tax conference. It's all very tragic. There's no rom-coms for our world. And for us, we're looking at moving to Truckee. When we look at taxes as a whole, we're going to, the next place we buy is probably going to be the place we raise kids. So we're going to be there 20 years. Grand plan, right? Man plans, God directs. So what are the factors that come in when you're looking at that picture? Property taxes are huge. In Nevada, there is a state statute that kind of limits your residents in terms of how fast they go up, but they move up quite a bit faster than California, which has Proposition 13. So by looking only at income taxes, we would exclude how much we could save in the long term on real estate taxes. And so we would put that in the mix. For sales tax, which is usually when we're looking at different states, the big three is property taxes, income taxes, and sales taxes. And if you're running a business, employment taxes. California tends to be heavier on the employment taxes and heavier on the income taxes. Usually lighter on the property taxes if you're going to be there a long time. If you're going to sell your house every 3 years, this is not going to work, because you'll just always be paying the highest rate as you step up. Versus, say, if you buy into a property, my parents, they pay a ridiculously small amount of California property taxes, so much less than they've ever paid in California income taxes, compared to what someone who bought that property would now have to pay. So there's advantages and disadvantages when you look at those four. And so I try to say, look at the whole picture of what you're doing. If you're a contractor, as an example, construction contractor, and you're looking at where to start a business, insurance is going to be a huge factor because both the states are going to insure you at very different rates, very different cost structures. Licensing is also going to be very different. Obviously, buildings either stand up or fall down based off of skills and some building codes. But beyond that, getting the license and how useful the board is to you and how accepting the board is, for some people, Nevada is never going to be an option because they are a bid limit state. And they're never going to be able to put enough assets together to bid the jobs they want. California is a right-to-work state. It's a different thing. You can bid on any job you want. They have other rules to sort of fix that. Just get bonding for it. But it's a different approach. So you have to look at more than just tax elements. But from the tax elements, those are usually the big factors. Income tax, property tax, sales tax. Sales tax between the two states are pretty much even. They haven't... Nevada has raised theirs to the point that some places they're higher than other places in California. So where is your customers? Where are they going to be? Beyond that, there's ideas of like economic nexus, which is a magical made-up word that says, even though you've never been in the state, we still have the right to tax you. And that's because you're generating too much revenue in the state. And that's something that like Amazon and all these other lawyers are going to be fighting about for the next 5-7 years. But it's beyond that, those are the things that you look at is, what are our goals? So for my wife and I, Truckee a push. Then we also have access to, California ranks in the in the higher in the education level than perhaps Nevada does. So for us kids, if we're planning to raise a family, that's a factor because that's how the money's spent. We may also want to try to take advantage of the UC system. So we might need residency in order to try to get in-state rates. There's a lot of ways that you can kind of look at the problem and say where the financial outcome will be.
That was a very detailed answer. So I'm going to throw another question to all of the panels, maybe starting in the middle. If I'm an individual either starting a business or doing personal finances, and I realize that I need help, don't know what I'm doing, or my assets and income have grown to a size that I just need someone to help, what qualities and qualifications should I look for bookkeepers, accountants, retirement planners, financial planners, when I'm going to shop around and find the person that's right for me?
Actually, that's kind of funny because when it comes to bookkeepers, unlike CPAs, we're not regulated. So basically, anybody with a laptop can call themselves a bookkeeper. I remember I was in like year 2 of my practice. I came across an article that's basically was like, how do you know if you're a good bookkeeper? And it was written by an accountant. And it basically started with, your clients love you? That's great. But they have no idea what you do, so it means nothing. And the bottom line was, do accountants want to work for you? Do accountants send you work? And at that time, year 2, I already had 2 accountants that were sending me work. So I was like, okay, that's a good sign. Maybe I need to go out to lunch with them and ask them what I'm doing good and what they want me to approve and use that. So with a bookkeeper, talk to your accountants. Talk to someone else who has a bookkeeper that they trust. Don't talk to the bookkeeper. I mean, you can talk to them, but you have no idea. There's no way. I mean, I don't think we're even on, most of us are on Yelp or anything like that, If you're going to be using a specific product, you're looking to use QuickBooks, then go to the Intuit website, and they have find a local pro advisor or find a local expert, and you can see in this in your local vicinity who's a certified QuickBooks pro advisor. That means we bothered to actually learn how to use the program, not just do the data entry in it. That means we can troubleshoot, we can go clean up messes that were created by people who got convinced that they could do it all themselves. And look at what certifications they have. Some of them only have QuickBooks Online certification. If you want to use desktop, maybe you need to go keep looking, and vice versa, Ask other professionals, ask other business owners who they're using, we go back to talk to other people. With bookkeepers, ask other people why they trust their bookkeeper and what they like about them. If you have an accountant that you're working with, ask your accountant if he has an in-house bookkeeping department or if he has a bookkeeper that he recommends. If you do that to a few of the accountants in town, they'll send you back to me.
Should I trust how many stars you have on Yelp?
No. No, because Yelp, we go back to that first line in that article. Your clients love you? Great. They have no idea what you do. My clients don't know what I do. They wouldn't be able to do it. I mean, to do it and be sure of the accuracy of it at the end of the day. No, they hope it's right. Their accountant reassures them at the end of the year if the accountant's not going, what the hell, these numbers don't look right. But really, it's a terrible thing to say. But it's the reality of my industry. It's just not regulated in any way, shape, or form. And when I first started and someone told me, oh, my neighbor will do it for half your rates, I used to try and explain the value of, you know, someone who knows what they're doing. And now I just hand them my card as I walk away and I say, call me when you want me to clean up that mess. It's so rates is a good factor, sadly, because someone who's charging $20 an hour in this industry, either they're just starting or they don't want. I would say don't even talk to someone who's charging less than $30 an hour. And if they've been in business for more than 5 years and they're still charging $30 an hour and they have time for you, don't talk to them. You get what you pay for. But yeah, your accountant is probably your best way to know if your bookkeeper is doing their job.
So she keeps referring to you, Darren, so I'll let you go next.
So like, we don't do bookkeeping in our firm. We do it for a couple of clients that have foisted it upon us, but we avoid that because we find a good bookkeeper will spend a lot of time on a weekly basis with a client, and they're going to do that at a good rate. And to get a CPA is never going to be affordable for that, unless you're a very complicated multi-state structure and I have one of those that we do. And yeah, there's a lot of bookkeepers that wouldn't want to touch what we're doing. And that's okay, because there's very little of that work. And there's so much other work. So I maintain a list of bookkeepers that I refer. And usually someone says, I need a bookkeeper. And I say, well, let me make a couple of calls, because they're always full. But every now and again, one frees up, and I can shuttle them in. And other than personality conflicts, bookkeepers that we refer are they're very stable. Bookkeeping, like she said, is an unregulated industry, so we get a lot of different people, some of whom have only learned to use the product. They've never learned to do bookkeeping as a rule, what needs to be tracked. They've learned, I can do the data entry into a check, because QuickBooks makes it look like a check. I know how to do that. And QuickBooks make it look like a deposit slip. I know how to do that. They don't know what reconciliation is. Don't automatically reconcile.
And what about qualities that you should look for in an accountant?
So, like in a tax preparation is actually also largely an unregulated field. Most people don't realize that, but anyone can actually prepare taxes for a fee. And some states have chosen to regulate. I think we're up to about maybe 10. California is one, Nevada is not, Oregon is, New York actually is and cares a great deal about it and actually tries to enforce it. And most of the time, the requirements of licensure for the state licenses, just a little bit of training, usually about 20 hours of training a year, and sometimes they fingerprint you and sometimes they don't, but that's basically it. It's largely an unregulated field. That works great if you're a simple W-2 person. If you want to start a small business, then you're going to need a scale higher. If you're going to rent your house, you need a scale higher. If you're going to do things that are perhaps a little more interesting or work in multiple states, you're going to need to scale higher. So you have sort of this initial level of, just about any bookkeeper is probably going to, or any tax preparer is going to do a pretty good job. And I would generally tell you, if you're at that level, you shouldn't do it. With them, you should probably be trying to use a product like TurboTax or TaxAct, and you'll probably get a superior result, because the questionnaires are more thorough than the person is. But some people hate taxes, and they want to go to someone else. Anything but don't make me do it myself. There's people for that. When do you go up higher? The first licensed field is what we call an enrolled agent. And an enrolled agent started off with, it's someone who takes regular training every year and also passed a comprehensive exam on income tax, and it's a national license. And people who used to work for the IRS, I think it's after 8 years or so, if they leave the IRS, they're automatically granted that license as an enrolled agent. And that's going to be someone, if you have a small business, that would be the lowest level you'd probably drop to, because they're going to be up on the business laws, they're going to be up on the tax laws. I assist a lot of EAs from time to time. We call them EAs for short. That's their abbreviation after the name is EA, means enrolled agent. Because sometimes they'll run into a technical tax matter that's beyond them, because they just had to take hours of training and take a test. CPAs go through usually most all the states now, it's about 150 credit hours of education, so equivalent of a master's degree. Some states require a master's degree, some don't. Most just require a bachelor's degree and then master's degree units. Usually about 30 credits of those in accounting, so another 30 in business, maybe some additional work and study. Then you do the residency or the internship for about 2 years. Different states vary a little bit. Some it's 2,000 hours, some it's 4,000 hours. At what level do you need someone who's got that much training? Sometimes it's just to resolve a technical question, and that's where you just come in and say, what's the answer here? How do I solve this problem? And we do that, and you move on. And the EA is enough. And a good CPA is going to just tell you whether or not that's, you're way off the beaten track or not. And a good EA is going to tell you whether or not. But that would be sort of people who are maintaining their training, because tax codes change all the time. They change at the federal level, they change at the state level. Most EAs start to break down around multi-state taxes. Being on a border town, that's where we see a lot of it. We don't see a lot in Nevada because Nevada doesn't have tax, but once you start adding states like Oregon or Arizona or Hawaii into it, which is actually pretty common. I have a rental property in Hawaii. What do I have to do? I have an investment that's running in Bend, Oregon. What do we have to do? I've decided to organize my company in Wyoming because I read it on the internet. What do we have to do? That's when you're going to start needing to get to a higher sophisticated level. And the fees are going to change accordingly because of that. A lot of minimum fees for a lot of EAs are going to be about half of those for CPAs for the same level of return. And it's because there's a lot of review and a lot of training that goes into that, because we're trying to do it at a technical level. So a lot of times it's a graduation process. But what I would tell you, if you're looking at an EA, I would ask if he has any relationships with CPA that he can get support with. Because that's going to be your first indicator as to how much does this person really care about their clients, that we have a problem, we're going to go and talk to someone. Just like I have EAs that come and consult me. That's going to be a big indicator in terms of how serious they take it. Otherwise, they're just taking the minimum training. And yeah, there's a couple people here that I wouldn't send anyone to, but that's really just a factor of how they've chosen to operate their business. And I've got other people that are like, look, we're busy, go to these people, they're going to do a good job for you. And yeah, they're not CPAs, but if something comes up, they'll call me because they know when they're out of their depth.
Max, same question?
Yeah, similar in the stance of CPAs and EAs, what have you. It really depends on how complex your situation is. Do you have multi-layered businesses? Are you a high net worth individual, high net worth business, what have you? Are you looking for a fee-based plan, or that's a much higher net worth area? In terms of a financial advisor or financial planner, it's not always. There is a lot of independent planners out there, advisors that aren't necessarily affiliated with one large firm. It could be an independent person that does a great job and really handles everything well and really has the client's best interests in their hearts. However, there could be somebody aligned with a big firm that doesn't have that same best interest in mind. Our industry is regulated extremely heavily, so if you don't have the client's best interest in mind, you're not going to be in business for very long. So that's also good to look at the track record of the individual. Have they bounced around a number of firms in very short amounts of time? Have they have any marks on their FINRA regulatory website? You can look up any financial advisor out there. We're online. You can look us up to see if we've had any marks against our licenses. Have we had any penalties against us, what have you. But also going to your other advisors, maybe your business attorney, maybe your CPA. Who do they work with? Who do they send their clients to? You know, who do your friends work with that they've had success with? Not necessarily, you don't want to go off of, oh, this is my buddy, he'll take great care of you. But at the same time, you know, if that is a good fit, then, you know, maybe you can find some success with them. But again, at the end of the day, there's a number of different factors, and you really want to, you know, do your due diligence like anything else. If you are shopping around, you want to make sure it's the right fit. And oftentimes, you know, you may not find the right fit right away, but there's plenty of options out there, and doing your own research can be beneficial.
Thank you. So I want to, I guess, unless there's any questions from anyone in the room. Yeah, I'll repeat.
So Max, in terms of like all the resources out there, is there a calculator for doing like an IRA versus a Roth, and like what that sort of payback? Like I know it's all kind of assumptions, but like at what point do you break even with what amounts?
So for the stream, so we make sure everyone heard, the question was sort of, is there an online tool where you can calculate different returns on Roths versus traditional IRAs, break out and try to find that sort of optimal mix for your retirement to maximize your benefits?
So that's oftentimes where we will actually defer. I oftentimes defer to whoever's individual's tax advisor and what that option may be, because it may be beneficial depending on that person's income structure to have both, depending on how they're taxed on their income and what have you. Because, I mean, for instance, in 2015, I had a client contribute to a traditional IRA, but in 2016, his advisor advised him to contribute to a Roth IRA because it didn't affect his taxable income enough to make that deduction worth it. Saving on the taxes down the road versus the taxes today became a better benefit for him in the long run. In terms of the returns, that's also where you're investing. But in the long-term taxation of it, that's where we really want to look at. You know, is shoving $5,500 into a traditional IRA really going to change your taxable income enough to where it's beneficial, or should you just be putting that same $5,500 into a Roth IRA? Or can you even do that, depending on how much money you make? So there's a lot of different factors, and that's where, you know, oftentimes we work with our clients and we have a board of advisors, you know, one being their CPA, and we want to defer those things to them and to see what's the best move. So hope that answers.
Yeah. I've got more. We have more time. So for me, in terms of starting a business and like creating that initial budget, is there like a savings amount that you kind of either recommend or something like that to be able to like burn through if for like those bad assumptions? Or
Yeah, so the question is, when you're budgeting and planning this business, or I guess even personal finances, how much of a sort of fund line item do you budget for to make sure that those unexpected expenses are covered somewhere? I know I always learned, like, add an extra like 10% to something, to a line item of the total you thought you were going to budget for I forgot I needed to buy a printer or what have you.
That's, you know, I would even start with how long, you were saying 3 to 6 months of your own personal expenses. I would start with assuming that the first 6 months to a year that I'm in business, I can't pull a penny out of the business. So that either my spouse or partner is making enough money to support us both and we tighten our belt a little bit, or, you know, realistically, you can even go up to 5 years before you can even start pulling money out of your business. With a service business like mine, I have very little overhead. So that gets smaller. If you're selling products, the more overhead, the more expenses you have, the longer it's going to take before your sales cover everything. So it's really dependent on your industry, how long. And when I say how long, it can be up to 5 years, realistically, where you're not really looking to have profit. You're just staying afloat and staying open another year. So
keep going there. In terms of like and you can kind of simplify this because I'm sure this is really complex, but in terms of like the dual state thing, a sole proprietorship and you're having your business in, say, California, but your personal is in Nevada, can you just kind of, in a somewhat simple way, because I'm sure it will all be complicated, explain sort of how that taxation works?
So yeah, the question was if you had a sole proprietorship, or I guess in my case, I work in Nevada, live in California, or if you had your business in California, lived in Nevada, where are those subtleties?
Right. There are two factors that come into play. First is called residency. What state are you resident in? And the other is going to be called apportionment. So let's unpack residency. Residency is about which state you have a closer connection to. Most of the time, it's the state you live in. Sometimes, if we're really creative, it's not the state you live in. But most of the time, it's the state you live in. That state has a concept called nexus, which is basically they have a domain and control over you, or they have the ability to impose law upon you. That includes the ability to tax you. Many states tax you, if you're a resident, on any income you earned in any other state and in any place in the world. And you're taxable at that level. So let's take, you're in California, maybe you live in California, your business is in Nevada, your business can be in Guam. California will still tax it. Now, all of those states that the business is in may also have the ability to tax that state, because the business is resident to Nevada, or it's resident to Oregon, pick a state that actually has taxes, right? Oregon's going to charge a tax, and then California's going to charge a tax. Are you being double taxed? We solve that problem with two things. One is a state tax credit. So in the case of California, if you pay taxes on the same income to some other state, we'll give you a credit against the tax paid so that your effective tax is not doubled. The other is apportionment. How much does this state get versus that state get? And this state versus that state runs off the factors that work in that state. So in California, it's entirely revenue. How much revenue did you generate in Nevada versus how much did you generate in California? And whatever that percentage is, it's the winner. Most states operate on a three-tier factor, which is revenue, payroll, and property. Property like inventory, fixed assets, equipment, things like that. And then by looking at that, and then maybe applying a weighting factor, a lot of states double weight revenue, for example. Revenue tends to be very heavy in that area. This comes up in public policy. The reason California is revenue only is, this came up about 3 years ago. Governor Jerry Brown was talking about a tax benefit that exists by having your employees in another state. And what that is California used to be a three-factor apportionment. And so if you took your employees in California and moved them to Nevada or moved them to another state, then more weighting would go onto that state. And if it's a state with no tax like Nevada, you would actually avoid some California tax that way. So they went to revenue only as a quote-unquote stimulus to encourage people to put as many employees as you want here. It's not going to affect your apportionment. So those are the two primary things. So my father worked for a utility company in Nevada, and he lived in California. It means California got to tax all of his income. Some of his coworkers lived in Nevada, and they occasionally would have to do some work in California. And California would only be able to tax the occasional work physically done in California, but they couldn't tax anything else. So that's where residency really plays a factor.
Any more questions? Awesome. So as we're wrapping up our event, again, thank you all for being here and sharing some knowledge. I've learned a lot. I'll give each one of you, starting with Darren, working down, one final parting thought, and then maybe a little plug of if one of the people watching the video tonight on the live stream or later on our website, how can they find you?
Parting thought. Taxes can be complicated, they can be easy. Focus on the things that make it easy. Don't focus on trying to get too complicated. People talk about deductions and things. If it's a business, the rule starts at the statute, which is it's an ordinary or necessary business deduction. Everything else stems from that. Is this ordinary for the business, and is it necessary for the business? And for individual tax, it's usually around preference items. Is there something that the government is trying to cause you to do? Buy an electric car. Those are probably legitimate deductions. When someone starts talking about magical structures or put things into this pocket or that pocket and suddenly your taxes go down, when we're talking about structure or just changing the form of things and that reduces taxes, that's where you're probably wandering into the gray area. That's probably when you're wandering into the technical area. That's probably where you're running into the snake oil area. So that would be the area I would tell you to focus on. My Twitter is @taxwisdom. My website is tax-wisdom.com because I won't pay the cyber squatter money to buy the domain.
My name is Anik. I'm with Anik's Books.
That's A-N-I-K.
A-N-I-K. You can always call Brandy. With bookkeeping, there's always, the solopreneur, if you will. We get convinced that we're supposed to do it all and to be able to do it all. How much money could you be making spending the same amount of time doing what your business does that you spend trying to figure out your books? And then for me, I started my own business because as much as I love bookkeeping, I could not live in an office environment. I was miserable. And I was waking up every morning, and I loved my boss, and I loved my direct co-workers. It was the environment. I just could not. I was miserable. So when I wake up in the morning and I think, I have to do this, and I feel as miserable as I was when I had the security of a 40-hour paycheck, I start wondering why I'm doing this. So if you feel that way about your bookkeeping, let someone else do it. There's so many headaches at being your own boss. Why choose to do the things that make you miserable? You're taking risks. Reward yourself. And then you have the peace of mind of knowing that your books are accurate. The numbers that you're basing your financial decisions on for your business are accurate. The numbers you're giving your accountant or your financial planner are accurate. They're based in reality. That's a huge thing. I've seen some really, really interesting logical assumptions that really skew the numbers, and it takes a professional to go, wait, this can't be right. It's worth it. It's worth it. Don't pull your hair out. Hire a professional.
Max?
To that same point, oftentimes people try to do everything on their own. They want to do their investing, do their own research, what have you, whether they're a business owner or an individual. And it takes away from, enjoying some of the other aspects of life and, oftentimes putting that in the professional's hand and having somebody who's going to ask the questions that you might not be thinking of. You might not have found that one piece of information online that could be very pertinent to your specific situation. A professional is going to try to ask those questions. A good professional, in my world, we try to build out a comprehensive plan and really get to the bottom of what's most important today, tomorrow, down the road, and then we can, tailor that plan specifically and holistically to each and everyone's needs. Not just necessarily only retirement planning, looking at all the pieces of the plan to make sure they all fit together. And then also, making sure you get a bookkeeper because your numbers are very skewed, or making sure you handle your taxes or whatever. We can help align all of those and really just help clarify a lot of things that you shouldn't be, struggling with on your own. And you may have to pay a little bit more for that service or, whatever it may be, but at the end of the day, it's going to help clarify your life, clarify your business, and let you do what you want to do. Focus on the things that are important to you and the things you're good at. So I won't spell my last name, but it's maxpelargian.nm.com is the website. Probably easiest way is to look up Northwestern Mutual, and I'll be the first guy to pop up in this area. And thanks.
Well, thank you everyone in person, hanging out at the Mountain Lab down in South Shore or at home on the live stream. This was Tahoe Regional Young Professionals Adulting 101. You will be able to find this video to check it out later and decode everything that was said tonight at our website, TahoeTRYP.org. Again, thank you to our speakers. I really appreciate your time and wisdom and insight. And then, of course, Tahoe Production House, as always, for their streaming, and Mountain Lab for letting us use their space in the South Shore. Until next time.